Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is February 5th, 2012 edition of Market Outlook. And listen, be sure to subscribe to our new YouTube channel and give it a thumbs up if you like it. And if you haven't already, please visit MarketGauge.com to sign up for this free weekly market analysis. Now let's get started. Market had another really excellent week, closed on the highs for the week based on really good economic data. And let's go through the charts in a systematic way, starting with the S&P. As you can see on the monthly charts, we are well above a relatively flat but starting to rise 80-month moving average. In addition, you can see we had that wedge that I had talked about at the end of the year, broke out from the wedge. Let's just take a look at what I'm talking about. You can see we broke out from that wedge. When we go to the weekly and daily charts, you can see it's just pretty much gone straight up. We were potentially concerned about a backfill, but that hasn't happened yet. Now, on the RSI, not really overbought. Actually, the most disconcerting thing is, of course, the volume. Let me format this volume here and make sure we get the scaling right. And as you can see, for the month of January, we were up very, very strong. Had the strongest January out of the gate in many years, but on relatively light volume. And if you look at the volume on an ongoing monthly basis over the last several years, you can see that we're pretty much almost 50% under what the 50-month moving average of volume is. But nonetheless, still in gear, not quite at overbought levels, but reaching the top of the range, but not quite there yet on a very long-term basis. Looking at the weekly charts, let's take a look here. You can see that the 65-week, which is one of the key moving averages in the intermediate or weekly time frame, is rising. And it's above the 200-week. So again, all you can say is trend strongly in effect. You can see right here we have this rising trend line. This is now a touchdown of several points on this trend line. Very, very important support line. That line comes in probably around 127 this week, maybe a little bit higher. But overall, very, very much intact. Not quite yet at the highs reached in 2011, but looks like this market just takes any bad news, digests it, so it backs and fills a little bit, and any good news, it seems to accelerate to the upside. So overall, market action looking pretty good. Now, on the daily chart, we get a little bit more precision here. You can see one of the major features of the chart is that the 50-day cross to 200, golden cross, looks really good. Remember, this was the wedge we had spoken about at the end of 2012. Very much intact. Markets had some trouble trying to actually get any legs on the downside. We have now a very, very well-defined channel. We have a good solid uptrend here. We dropped a parallel up over here. So you can see upside count pretty close to the 138, 139 level this week. That would be hitting at the top of the channel. At the same time, the accelerated trend line is sort of important, so we really want to hold those couple of doji days from Thursday and Wednesday. That's a critical support level. Now, please take note that the RSI on the daily basis is overbought. So now the price is overbought, along with some of the market internals still at overbought levels that we had discussed last week, that we were at those levels and looking for a potential turn down, never really occurred. So we're just, sitting at these high levels. Now, of course, one of the things that's very important about indicators is that they have to be confirmed by price action. So it's only one piece of the puzzle. Right now, price action very strong. Is this a point where I'd be rushing in and adding to positions on the long side? I would say no, but I would be taking stabs at stocks that are well set up and do some shorter term trades, mini day trades, etc., and those with positions on and with or a portion of positions, leave those tails on and put in the trailing stops and let the market continue its move. But on the other hand, if the short-term structure sets up in such a way that the market is indicating that the short-term overbought condition is confirmed by price action, I would certainly take advantage of that as well. Now, let's take a look at gold. Gold had a tremendous run off the lows, and Friday's action, along with a really good jobs action, basically points to that the potential blow-off might have happened off of this bounce from an oversold condition. We didn't quite get up to the top of the bigger channel, but it nonetheless is still in effect. But the short-term pattern is of interest. We had a new 60-day high on Thursday, closed on the highs, and Friday's action suggests anybody who was short that caught that tried to get in through the new highs and has been in really since the past week or so is now underwater. That's not really a good sign for the short-term projection of the market. In addition, the volume on the sell-off was pretty darn high. So although we haven't reached the very top of this longer term channel that was put in from the highs back in August of last year, right? We taken from the lows here to the top here. This is a valid channel. Critical level to support is right now this 10-day moving average. We closed right on it. It will be very interesting. Any continued action on the downside, along with an opening range breakout on Monday morning, would trap 1, 2, 3, 4, 5, 6, 7, and anyone who bought on the big move up last week would be potentially underwater. So interesting. We call this sort of a train track type pattern, up one day, down the next. And the fact is that this low close, sort of interesting. We take out the lows put in on Friday, as well as penetrate the lows from 5 or 6 days ago. Definitely merits watching, and there's going to be continued follow-through. Support basically down around the 162 level. That equates to about a $50 or $60 move on the downside in the underlying gold bullion. Let's take a look at the monthly chart. Can't really argue with the monthly chart. We came right down, tested it, fell and bounced right off of oversold levels on the daily RSI. If you go back, you can see that when the market dropped down here in late December, we hit oversold readings, and boom, the long-term trend reasserted itself. Again, the other thing that occurred is on the 65-week moving average, bounced off of that as well. So not quite hitting overbought levels on the RSIs in any of the periods, but nonetheless running into some headwinds on that short-term technical patterns. So let's keep an eye on it. Is the trend still intact? Absolutely. Are we susceptible after this very sharp rise? We went from 150 to 170. It's over a $200 move in a gold bullion. That's a pretty sizable move. Could we see a correction of 35 to 50%? Absolutely, off of this move. Let's see if this support level around 160, 170, 162 holds, which is the 50-day moving average. All right, now also of interest with the really good economic news, what's happening with interest rates? Now everyone knows that Bernanke last week or 2 weeks ago said we're going to keep rates low indefinitely. Well, what happened is you had a pretty nice rally off of that news with a gap, and we've sort of left yet another island of sorts and a test of a very critical level. You can see that we have a potential of a head and shoulders potential top forming here, right? Left shoulder, head, right shoulder, and the neckline right here. If we drop, we can easily see a drop, let's see, 115 up to about 124, almost a 9-point drop. So we could easily see if this trend reverses here, and this indeed plays out as, if this doesn't turn out to be support, and we start breaking through this critical level here, obviously first stop right around the 108, 109 level, and the full count off of the head and shoulders top would be somewhere around 100 or 98 or so. That would be your count falling into longer term support. Right? So if you take 115 to about 124, you're talking about 8 to 10 points off the neckline, and so that's 10 points, excuse me. The support level would be right around 105, 106. But initially, I would suspect that the 200-day moving average would give it some level of support. But look what's playing out here on the weekly charts. Right? Tight consolidation. I mean, we're at really, really low long-term rates, historically low. The financial crisis back in 2008, 2009, we're trading pretty close or around those same levels. So again, that critical support line, looking at a different version on the, or what I would consider the fractal of the daily chart, you can see that the weekly chart, that 115 level, 115.50 is clearly an important level. So that wraps up this week's market outlook. You can see that the good economic news is playing out in a way that is looking like interest rates may have run its course to the downside. Lower rates look like they may be under attack. It's certainly a possibility that we have to consider, and that Bernanke may have to change his plans based on a stronger U.S. economy than most people have anticipated. The same thing with that playing out in gold. Higher rates, improved economy, maybe a more stable economic environment. It's going to put some pressure on gold. Meanwhile, stock market, while overbought in the very short term, looks like the trend is strongly intact. We hit in NASDAQ 11-year highs. So all that's looking positive. Hope that helps, and look forward to seeing you next week. And again, if you haven't already, visit MarketGauge.com to sign up for this free weekly newsletter. And also, don't forget to check us out. And if you like what you saw this week or heard from us, go to our YouTube channel and give us a thumbs up. Thanks, and have a great weekend. Bye for now.